Signs of fragility in markets as investors navigate a growing list of risks, including worries about stretched tech valuations and a flare-up in Middle East fighting. Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. Oil gains as the U.S. launches military strikes against Iran, following the shooting down of an army helicopter testing the brittle ceasefire. A sell-off in tech shares resumes, with Korean stocks leading losses as doubts resurface over the AI trade. Investors now awaiting the U.S. May inflation report will ask Bridge Investments Omar Slim how the data might impact Fed policy and why he sees more rates volatility ahead. Also coming up, our exclusive with Malaysian second Finance Minister Amir Hamzah Azizan on why the government may not meet its fiscal deficit targets this year. And we're live at Bloomberg Invest Hong Kong, hearing from the Hong Kong Exchange CEO as the city's financial secretary, Paul Chan, touts the economy's strength.
The momentum continues to be quite strong. We are very committed in terms of developing our technology and innovation sector, which will be one of our key future economic growth engines.
We're live at Invest Hong Kong. The China Show co-anchor David Inglis is speaking with PAG's CEO and co-founder Chris Gradel at that event. Let's listen in.
And this is a theme that has legs, and that corporate governance theme again, drives lots of opportunities in Japan across multiple asset classes.
Let's bring China in. Yeah. I guess the starting point there, just to build on what we started on, just how underweight global investors are. So maybe just a mental exercise. If you, let's say you went to the US, a room of 10 people, and you brought up the topic of China, how many would remain in the room? How many would walk out?
I'm not sure they would. I'd hope they wouldn't walk out, but yeah, I think there's still probably 9 out of 10 people will just not do China in the US. So let's see. I think maybe there's a little bit
has that changed?
Friendly relationship. It hasn't really changed yet.
Okay.
I think a couple of years ago, maybe people didn't even want to, they weren't even interested in asking. I think now people at least are interested again from a macro point of view, what's going on in China, but not allocating capital yet. Maybe a little bit on the public side, but on the private side, still, I think there's, from the US, not much interest.
Sure. Your call on China is underpinned by your view on the macro.
Yeah.
We've had this conversation, and I think what underpins that macro view is what happens in the property market. I think we have a graph. Thank you so much. Right on cue. Yeah. Thank you to our producers here. I think what you're looking at, just for the audience, this is a month-on-month change in, I believe, new home prices across 70 cities. This is across 6 years. So effectively what you're seeing here is for the better part of the last 6-7 years, it's been declines month on month. As far as new home prices go, what's the direction of travel that you see? And does this need to improve for the macro to turn?
I think, China's growth in recent times have been really largely driven by exports, and consumption has stayed very weak. And,
right.
We believe, we've strongly felt that household consumption is not going to return until the property market stabilizes. This was a major hit to household balance sheets and really impacted confidence. So we've been watching very closely to see, when are there signs of that property market stabilizing, and also watching at the same time consumption to see, because, while this property price crisis has been going on, Chinese households have been saving like crazy. So there's about 23 trillion RMB of household cash savings in the bank. And you only need a little bit of that. 3% of that is a 4% GDP impulse. So we believe once that comes out, it could be a huge demand impulse into China. Some of that will also go into equity markets and other investments. And that can be, I think that's something that's an extra sort of boost to China and the global economy that maybe isn't fully sort of baked into people's assumptions. So I think that is there. But, so I think the property market is looking a little bit better.
Okay.
In first-tier cities, prices are starting to stabilize, even go up a little bit in Shanghai. In second-tier cities, the rate of decline is slowing. We did last year the buyout, we led the buyout of Wanda Commercial, which is the largest
that's right.
shopping mall manager in the world.
Not a lot of people know that. You're actually the biggest mall operator in China.
Yeah, it's an amazing business, actually. So it's very interesting.
And that was Chris Gradel at Invest Hong Kong. Let's get to our top story now. U.S. forces have completed multiple waves of strikes inside Iran, hours after President Trump blamed Tehran for shooting down an American military helicopter. The U.S. military says it hit Iranian air defense, ground control stations, and surveillance radar sites near the Strait of Hormuz with precision munitions from fighter jets. It also says the operation was a proportional response to recent attacks on U.S. forces and commercial shipping. For more, let's go to Dubai and Middle East correspondent Abu Omar. And Amir, what does it mean that we see the U.S. military's involvement again after a week of most intense hostilities since the ceasefire began? This is really tit for tat.
Yeah, good morning, Haslinda. So look, an uptick in hostilities yet again, this time by the United States directly involved in Iran. And look, President Trump told ABC News yesterday that he will retaliate against what Iran did yesterday. According to him, that Iran had brought down a military helicopter. The two crew members, the American crew members in that helicopter, were safe. They were rescued. But President Trump vowed a strong retaliation against Iran, and that happened overnight. Now, Iran, just a couple of hours ago, retaliating against the U.S.'s response by hitting air bases in Kuwait, Jordan. They also hit the U.S. Fifth Fleet in Bahrain, sirens sounding in the neighboring GCC country. And so again, you're seeing this uptick in hostilities. Meantime, President Trump maintains that a deal is close. He said that yesterday, speaking to reporters in New York, telling them that a truce with Iran could be reached within a day or 2 days. And then we also have from our own sourcing that the mediation process is still very much ongoing, that Pakistan is still taking an active part in mediating between the two. But again, an uptick in hostilities after a week of hostilities between Israel and Lebanon and Iran, Haslinda.
And Amir, we're also hearing that Israel continues to attack Hezbollah, and we now hear that Iran says it will respond, it will retaliate.
Yeah, which maintains their line from the very beginning. Look, Lebanon has emerged as this last sticking point to Iran because of their ally Hezbollah in southern Lebanon. Iran maintains that they will not come to the negotiating table unless Israel's attacks against Hezbollah stop. Now, Israel refuses to do that because it cites the attacks by Hezbollah itself on the northern part of Israel and says that the incursion that it has right now into the southern part of Lebanon and the cities of Tyre, for example, and Nabatiyah, is going to continue. It is the deepest incursion in 25 years, since 2000 at least. So we still have a lot of concessions that are not met. Lebanon, again, a very sticking point. But then again, you have the other sticking points that are the highly enriched uranium, frozen assets, and oil sanctions that are just not responded to yet. Haslinda.
Middle East correspondent Abu Umar, thank you so much for that. Asian stocks were already under pressure even before the latest fighting in the Middle East. That's as investors continued rotating out of tech shares that have driven much of this year's rally. Avril Hong has been watching all the market moves for us today. Avril.
Yeah, Has, we're seeing the region's benchmark in negative territory, some of it from the jitters amid the war, but also as traders watch out for the US CPI print and watch for the extent in which these price pressures have been building. Of course, following on from last week's jobs data and how traders have been pricing in a rate hike from the Fed. Some positioning suggests that some see it as soon as September. Of course, in the US overnight, we saw how those chip stocks initial gains, but that evaporated. A lot of volatility on the stocks. Today in the Asia Pacific, the Kospi is in focus after yesterday's 8% surge, but you're down today. And this is, of course, a market that has been attracting leveraged money. So the wild swings, I think, are just part and parcel of these moves. What's interesting today also is what you're seeing in Hang Seng, not faring as badly amid the risk management across the region. Might have something to do with the gains in telcos, data center operators, the Chinese names, given this $295 billion spending plan that seems to be coming from these Chinese officials. Now flip the board, because when it comes to the emerging markets, we're keeping tabs on the yuan as well, because PPI today did suggest that maybe the reflation narrative is intact, but the ringgit as well, it's best in class this year, but this month in Asia is the worst performer. And of course, as you spoke to the second finance minister, they don't sound too worried about the slide in the local currency. The rupiah certainly is something that has gotten investors very worried. We saw that off-cycle hike just a day ago, 25 basis points to 5.5%. The question is, what happens next week when Bank Indonesia meets 25? 50, some say 75 basis points. What is needed to arrest the decline or the reversal that's needed for sentiment, given how investors are still concerned about these investment risks that have built up amid Prabowo Subianto's tenure? Has?
Well, the question really is whether monetary policy can fix the rupiah's woes. Avril Hong, thank you. Let's get more market insights with Omar Slim, co-head of Asia Fixed Income at Bridge Investments. Well, surprise move by Bank Indonesia. I mean, that has provided some stability, but problems are still there.
Yeah, the problem is still there, and it remains to be seen if the stability will be long-lasting or not, especially that I think Indonesia has had some issues, particularly since last year, frankly, and some of it is related to policy communication. I would frame it as such, and I think the decline in terms of investment sentiment, or deterioration in terms of investor sentiment this year, obviously the Iran war did not help, but I think is a bit more idiosyncratic to Indonesia, and that continues to be the case.
Can monetary policy help? I mean, we saw a surprise 25 move. It could move again by 25, even 50, some say, as we heard from Avril. Can monetary policy help?
I think the monetary policy can help, yes, but the operating word here is really just help, because I think it really needs to be a mix of things, particularly in terms of fiscal policy, institutional framework, the strengths of the institutional framework, governance, I think is very important. And I think when it comes to monetary policy, I think it's also wrong to kind of think that monetary policy can fix everything. For instance, now there's talk about broadening the mandate of BI, and which essentially will include inflation, which is typical, but also FX, economic growth, and labor, helping the labor market. I think that's quite a bit to juggle, to be honest. And I think, for instance, yesterday there was an off-cycle hike, 25 basis points. Clearly that was targeting the currency markets, but what's it going to do to economic growth? What's going to do to debt serviceability or the labor market? So I think monetary policy is only a small piece of it, an important piece, but it's not the whole picture.
Murmurings of a credit downgrade, there is a real possibility that may happen. And we've seen the rupiah breach 18,000 even before such a move. I mean, how much lower can the rupiah be?
Yeah, 18,000 is kind of that level that everybody's watching, and frankly, it is everybody's watching because some of the policymakers kind of have wrapped expectations around 18,000 in terms of where they intervene. My view on intervention is that it is at best a short-term fix, and it never works, and it's almost sometimes an invitation for market participants to pile on that trades, sometimes. So I think the bigger picture is the institutional framework, the strengths of the institutional framework, fiscal reforms, and you're quite right about the credit ratings. I think the rating agencies, I would expect them to be relatively patient. But I would say that that's a risk, and I think that's a risk that policymakers should be mindful of.
And what's the risk for the bond market?
Well, the risk for the bond market is that because of the foreign participation, the obvious risk is one, more volatility, and two, for a further sell-off. And I would say the main risk is that for Indonesia, and that has actually been a relatively positive trend over the past few years.
It's been a high yield play.
It has been a kind of a higher beta play, but over the past few years, Indonesia has become less of a high beta play. Now we're starting to see a reverse of that, and again, that's related to Indonesia specific factors as well as the broader sentiment. So the risk is, is the higher debt serviceability, which is, I think, is a problem.
And Omar, when it comes to the broader market, of course, it's hard to take a position when you're so headline driven, and the headline changes every single day. When you take a look at the treasuries market in particular, what are you reading into that?
Well, the treasury market, I think the big story is that there has been a complete repricing of monetary policy expectations for this year over the past 2-3 months. I think that's highly justifiable. I think very importantly for the treasury market specifically is that even if we forget about the Iran conflict and we look at the economic data coming out of the US, there are some economic data that are mixed, but generally the picture coming out of the US is still a solid one. So even if we, for instance, we assume that there will be a de-escalation and even a resolution of the Iran war, I think the US is still in a pretty good shape. And I think that the fact that we essentially priced out any cuts for this year, at least for the next 2 quarters, I think that is something that can be defended, actually.
Some actually say we could expect a price hike by September. You say no such thing, no hikes this year.
I think the probability of a hike is very, very low. And I think that's for a few reasons. The first thing is I think the Fed usually looks through, at kind of quite a few quarters, let's say 2, 3, 4 quarters at least.
What if CPI on Wednesday comes in strong?
Even if CPI comes in strong, I think the Fed would want to see many kind of data points before kind of coming to that conclusion. I think the market might go in that direction, but that's not necessarily the case for the Fed. And I think let's not forget that we have a new Fed chairman, and I think making a policy mistake or a potential policy mistake early on would be quite, not well seen. So my view is that the chances of a hike, certainly in the next quarter, but also for this year, remain very, very slim.
There are a lot of themes at play here, including AI as well. It's not just a theme within the equity markets, but also in the debt market. Hundreds of billions of dollars, coming in, and AI has become a debt market problem, hasn't it?
Well, it has been a very strong technical factor, yes. I think it has become a problem in some segments because of the disintermediation that AI is expected to have, particularly in terms of some software companies and so on. But it has been a technical issue in the sense that we're seeing a lot of supply, particularly in the US, like a lot of supply. And I think that will continue to be the case for the next few years. So it has weighed in on the market. It even has weighed on in terms of the rates market, quite frankly, particularly when it comes to the long end. So I think that's a phenomenon that we continue to see, particularly in the US, less so in Asia, but in the US it is very much present.
Do you get in? Do you stay out? I know Fidelity says, stay out. You're not so well compensated to hold it. What's your take?
About the credit markets broadly, I think the credit markets, particularly on the investment grade, really have been quite resilient. I think that we are in a situation where the fundamentals generally remain resilient. The direct impact of the Iran conflict, Iran war, whatever you want to call it, has been so far relatively limited, particularly in Asia, despite having a big impact on an economic front. So I think one needs to remain invested. Where do you stay invested and how selective you are? I think that becomes the key topic. But I wouldn't make a broad brush statement in terms of not being in the market. If you had that view, you would not have done well this year, particularly in Asia.
I just want to touch on another asset class, and that would be FX, emerging market currencies in particular. It's kind of like waiting for intervention given where they are trading right now. I mean, we have the Indonesian rupiah, we have the Indian rupee, and of course, even though the Malaysian currency is resilient, I mean, we're seeing it at the lowest level in, I think, about 5 weeks. So how concerned are you when you take a look at where these emerging market currencies are trading?
I would not bucket the ringgit with the other two currencies. I think there are some relatively valid fundamental concerns when it comes to the INR and the IDR, the rupee and the rupiah. And I think the market is looking at them correctly in the sense that the market is a bit more cautious when it comes to those two currencies. One can argue if they are too, the sell-off has become a bit too kind of pronounced at these levels or not. But I would say that the market has been justified in terms of being cautious in these two currencies. The ringgit, I wouldn't read too much in terms of sell-off. I think Malaysia remains a good story. Of course, that's not an emerging market currency, but we have the yen story as well, which is a separate story, where I think that has captured quite a bit of market attention.
Omar, always great to have you with us. Omar Slim of Bridge Investments. Plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Back to Bloomberg Invest Hong Kong now, where editorial director Eric Shetzka is speaking with Apollo's head of Asia Pacific, Eiji Ueda. Let's listen in.
Demographics driving the economy, and everybody know what happened after the working population hits. Both countries went to deflation, and real estate problems, non-performing loans, looks very similar to me. And also, Korea is a shrinking population as well. But the Korea path is slightly different because size of the economy is slightly smaller than Japan and much smaller than China. And few number of very good companies can support the country's economy by export. So Japan and China has 10-20% of the export in terms of GDP. Korea has a 44%.
Japan's fatal mistake many decades ago was not recognizing bad loans.
Yep.
And it created an industry of zombie banks.
Yep.
Is China making the same mistake?
It's hard to say, as previous Chris said. I think China trying to learn from Japan experience. Unfortunately, Japan again the fastest, earliest country faces this demographic change. There's a lot of test and experiment, but China learned a lot from Japan case. So I think they can do differently.
Are some of these outcomes inevitable, though, in the sense that the demographics are what they are?
Yes.
And in the absence of massive immigration, some of, there's sort of a foretold future.
Yeah, I think there's a lot of synergy, the overlap between Japan and China for sure. But export can change the situation, as I said about Korea. So I think the China strategy for next 5 years really push the industry to grow faster, not the consumer and consumption. We'll see how that goes.
We will. I want to ask you a bit about India. There's a lot going on in India, world's largest country in terms of population, 1.4 billion people. And of course, in theory, as the fastest growing major economy in the world, it presents enormous opportunity for a firm like Apollo. What excites you about India? What gives you pause?
First, it's the fastest growing economy in Asia. Second, the size of the economy.
Right now, we're headed to Malaysia. Its second finance minister says elevated fuel subsidies continue to weigh on government finances amid the Iran war. Amir Hamzah Azizan told us exclusively that the strain could put Malaysia at risk of missing its fiscal deficit targets.
If you look at what we've tried to do in terms of creating space in fiscal, right? We started this journey about 3 years ago, when we started adjusting subsidies for electricity, water, diesel, and now petrol. Fundamentally what we've done is put in new mechanisms so that we target the subsidies better. So groups that we really want to protect, then they are protected in some form or the other. In diesel, we gave cash transfers to protect the groups that are selected, whether they're agri-commodity or in terms of public transport-facing mechanisms or logistical cost-saving mechanism. That's important because the vulnerable groups in the society needs to be managed through along the way. But for everybody else, they pay market price. And because of that, the government continues to save money compared to what the old mechanisms were. So when I did my numbers originally, when the price was in the mid-70s, 80s sort of things, we were sitting at about 5 to 6 billion ringgit saving for diesel. Today, prices are much elevated. We're sitting at 9 billion or so of savings, because if we had to pay the original price, I would have been in much worse shape. So yes, the subsidy bill for the government has gone up, but it's a lot better than what it used to be.
What is the subsidy bill?
Subsidy bill, I think, depends on what the oil price is. Yeah, but when we started with what's happening in the Middle East, in the month of March, start with January. January, February, we were sitting at about 700 million, 800 million a month of subsidies for fuel. Come March, we were sitting at about close to 5 billion. Come April, there were some weeks that we were sitting at about a track rate of about 7.5 billion a month. Now, prices are moderated. We're back down to about 3.5 billion a month. So the key is moving against that. So yes, there will be a bit more fiscal pressure for the government because the bill has gotten higher, but not close to what we would have had to pay if we didn't do the subsidy rationalization.
At 7 billion subsidy bill, that's still about 10 times more than what it was before the Iraq War.
Yeah.
Yes.
But
so the question bags, the question that bags to be asked is whether that is sustainable going forward, because the war is into the 4th month and there's still no end in sight.
If you look at this challenge that we've been having coming up from the Middle East, we see this as a supply crunch, which has led to inflationary pressures that's coming in. So our support to the economy has been about providing lifelines. So we provided 5 billion ringgit in terms of loans that were coming in from Bank Negara to SME businesses. The government topped that up with another 5 billion using guarantees to support banking sector loans. And micro financing, we also topped up by another 5 billion. So 15 billion is put in. The banking sector has also supported in terms of some RNRs and MORA that has gone into the system. And that's giving the people who are affected breathing space. But the government has not looked at this as, I need to stimulate the economy. This is a supply crunch, this is not a demand crunch. So pushing in stimulus along the way is actually pushing more risk of inflationary movements. So I think this government has been quite prudent. This government has also looked at tools that are necessary and how it can do, and providing the support necessary for the economy to continue to run.
And in terms of your budget deficit target, we're looking at, I think, 3.5% from 3.7. On track?
I think the government is committed to continue its journey on the FRA. In the current challenge for this year, we'll probably be under a bit of pressure against that target. But it doesn't change the resolve of the government to achieve the target of the FRA in the medium term. But practicality, when prices go up, we will pull whatever stops that we can in order to create space necessary.
Malaysia's second Finance Minister Amir Hamzah Azizan speaking to us exclusively. Plenty more ahead. Keep it here with us. This is Bloomberg.
The central authorities are very supportive of Hong Kong. They want Hong Kong to succeed as an international financial center. When we put this into the proper channel, we can inspire the confidence of the mainland authorities.
Our, regulators are also encouraging this type of regulated and really, I think, compliant type of investments, investing overseas.
China are no longer followers. They are in many cases, global leaders.
The world was like, China is not investable, China is not investable. Today, we're seeing a lot more attention on China. The valuations are, on a relative basis, cheaper. There is value, and there's a lot of value.
Welcome back. You're watching Insight. The China show co-anchor David Inglis is speaking with HKEX CEO Bonnie Chan at Bloomberg Invest Hong Kong. They're talking about the IPO pipeline for the city. Let's listen in.
It's really the full value chain. So from chips to compute to large language models to applications to even, if you extend it further out, people talk about, energy, right? Which is very, very
That's a bottleneck too.
Yeah. And so, you really see a proliferation of all these issues in all the different segments within the AI bucket broadly. That's theme number one. Theme number two, I'm seeing a return of mineral companies in my pipeline. And that's very interesting. I think it's, broadly speaking, the mineral space is getting back into the right cycle. I think that has a lot to do with just how investors are diversifying. We saw the movements in metal prices last year, for example, right, from gold to silver to copper to anything which goes into EV batteries, for example.
Real world assets.
Yeah, so I'm seeing a pretty strong return of mining companies in the pipeline. The third one is A&H. That continues to be a trend. And I'm talking about companies which are listed on the Chinese mainland exchange coming to Hong Kong for another listing. And a lot of these issuers are really doing that because they want an offshore fundraising platform to support their internationalization journey. And I think that is now a tried and tested route, which has become very popular. The fourth theme is something I really like to share. So people always say, hey, Bonnie, your exchange is too concentrated on Chinese businesses. I know that we have historically been a very popular platform for Chinese-based companies to list. But when I did a double click on the 120 companies which listed on my exchange last year, what I found is very interesting. About half of them actually have revenue, more than half of their revenue generated from outside of China. So they are in fact already very international. I call them China MNCs these days. I also now begin to meet a lot of companies which are what I call born global. So on the face, you'll call them Chinese company, but if you really look into it, it's very international. And that's a new breed coming out, which I'm very excited about.
Talk to us about, that's a good paradigm shift, looking at the going abroad theme, going global theme of Chinese companies, China multinationals. You buy the S&P 500, you're not just buying US companies, right? These are companies that do business around the world. How much more momentum do you see? And I imagine, is that in the A&H segment that you see that? Not just? But how much momentum do you see that as a pillar this year?
I think it's going to continue on a growing track. It's inevitable in a way, right? So let me everyone talks about the SpaceX IPO.
Right.
For example.
I didn't bring it up, but okay.
Oh, yeah, I'll bring it up. So it's obviously a very exciting and interesting deal, but
yes.
A lot of people are also now looking into the supply chain behind SpaceX.
Sure.
And if you really peel the onion and look into it, I'm quite sure that you'll start seeing a lot of companies which may be what you generally looked at as Chinese companies. So what I'm trying to say is actually the global economy is still very interwoven, and the Chinese supply chain, really have a very broad coverage, and therefore, to your question, it's not confined to an A&H company. Like I said, you now will be able to pick up a lot of born global companies, which from the day they are established, is already quite global.
So safe to say we'll top last year's number, whether that's volume or actual money raised? Is that safe to assume, direction of travel-wise?
Yeah, well, let me say this.
Yeah, I'm asking
usually, the second half is always sort of more active than the first half of the year. So I gave the number for the first half already. I keep my fingers crossed.
It doesn't seem like momentum has changed from last year. But on the surface, we showed you some headlines earlier. There have been some changes, whether or not it's this focus from quantity to quality. In what ways have things changed?
Okay, a lot of ways. But one thing that I find very gratifying is when I go abroad, and I just got back from Central Asia, I found that my engagement with both issuers and I think more importantly with investors, a lot more interesting. I feel that global investors have now really turned their focus back to this part of the world. And 2 years ago, I probably will still be trying my very best to debate whether or persuade global investors about the investability of China. Now, I think the assumption is it's very investable, but how should we do it and when should we do it? So I found that the conversation to be a lot more informed, more interesting. That to me is a very big and positive change.
How do we need to interpret the recent news of tighter oversight into cross-border investments?
Okay, so you're probably referring to the announcement made end of May, 22nd. Now, we took note of that, and basically it's targeting illegal cross-border investment. But the announcement also made a point to emphasize that the legal official channels are fine, right? Such as the Stock Connect, which obviously have been in place since 2014. And so, to me, Hong Kong as a market, obviously we want good, strong activity, but we also want to put an emphasis on compliant behavior and activities, right? So to me, I feel that it will probably it's always good to tackle non-compliant behavior, but the fact that we can offer investors with a compliant and very efficient channel for them to do these cross-border investment, I think is probably going to position us very well.
Okay, so no issue that you foresee in the liquidity front being able to...
Let me give you the numbers. I always like to speak with facts. So since the end of May, if you look at volumes, let's focus on southbound, northbound. I mean, everything has stayed pretty much the same. In fact, May has been a particularly strong month for us. Last year, for example, southbound ADT for the year is at 121 billion Hong Kong dollars. It's improved about 14% year to date. Northbound has been very, very strong. So northbound last year was about 212 billion RMB. This is ADT. And now it's edging closer to 380, on some occasional days touching 400, right? And what that is telling me is, while I know, right, a lot of people is under the impression that, the Hong Kong market has done well because you have all these southbound flow. Yes, factually correct, but I put more attention on the fact that the rest of the world seems to be more interested to trade in Hong Kong, first of all, but also through Hong Kong into the Asia.
Into China, the northbound connect.
Yeah.
Let's talk about the product. You guys are getting into the index business.
Yes.
Okay, so what does that mean and how are you doing it? And how does that show up in our world?
Okay, so yes, we launched our HKEX Tech 100 Index in December last year. And why are we doing it? First of all, I think we always want to venture into what we call adjacent business, which plays to the advantage of our strong core businesses. And we know investors, a lot of them need benchmarks, to track.
But there's so many benchmarks already.
Yeah. Okay. So why do we start with Tech 100, right? If we look at what is available today, we saw sort of a white space that should be filled, which is an index which tracks a broader universe of technology companies. And by the way, tech companies, the definition has expanded quite significantly over the years. And so our Tech 100 actually also covers 18A and C, which other indices to date might not have. And the idea is that, we provide that, and hopefully that will give, or that will be a more representative, of what makes up our market, closer to the investor demand. And that's obviously the first step. The next thing that we should expect is obviously products, which will be offered on the back of these indices. And we're not going to stop with one. In fact, we also have, in the past few months, launched co-branded indices with other regional exchanges. So with Bursa Malaysia, we had now a co-branded large cap index, and it's constructed in a way where 60% are Hong Kong listed shares underlying, and the other 40% is Malaysian listed companies. And we will continue to stay close with the investors, and the idea is really to help them, or to provide them with the tools so that they can in turn come up with products or trading strategies.
You mentioned one of the things that people constantly talk about is your reliance on China, but you've been traveling. You mentioned you're in Central Asia, you talked about Malaysia. What's the strategy there? Why are you going out to, and you recently had a big conference here as well of, I think, ASEAN and ASEAN exchanges. So what's the thinking there, and how does that improve the product?
Well, I was listening to the previous speaker, Ueda-san, and I think he puts it very well. Asia, the Asian region, is getting a lot more interesting, and in fact, accounts for 40% of the world's population or growth, and that there are so many opportunities that we as an international financial center should really position ourselves to capture. With Asia, I also feel that Hong Kong is now emerging as a very good capital raising platform for a lot of regional companies. Many companies are already listed in their home market, but they might have already outgrown their home market, right? So with the need to continuously raise funds, there is definitely a demand for tapping a deeper market, which Hong Kong is. And therefore, to me, it's always going to be two pools of participants that I look at and I focus on. On the one hand, issuers, on the other hand, investors. Right. And it should apply not only in Hong Kong, in the Chinese mainland, it should be regional and global.
Should we expect more Central Asian and Southeast Asian names to list on your platform? I mean, you can mention names if you want to, but...
Well, there was already one Central Asia company which came to list on our exchange last year. I do hope that there will be more, so watch the space.
Okay, that's all we have time for. Thank you so much.
Thank you.
It went through very, very quickly. Thank you guys so much. Bonnie Chan, a round of applause.
Thank you.
That was Bonnie Chan speaking to David Inglis. Of course, she is the CEO of Hong Kong Exchange. She talked about how we've seen a robust pipeline of IPO for the Hong Kong market. In fact, she talks about how, the Chinese companies IPOing in the city are what she called Chinese MNCs, companies which a lot of presence in the world, a lot of presence globally, in fact. And when you take a look at the markets, the Hong Kong IPOs have continued to boom this year. The number we're looking at is $38 billion so far in primary and secondary share sales. That's compared with $26 billion in the same period. So it's already exceeded what we saw all of last year. So a robust IPO pipeline for Hong Kong. And of course, subscribers can also turn to the terminal for more on Bloomberg Invest Hong Kong. T-Live Go is your function for the latest updates, plus commentary, as well as analysis from our expert editors. Meantime, here are some other stories we are following. Tencent has raised nearly $4.7 billion from the sale of long-dated bonds, its largest debt offering since 2020. The Chinese tech giant says proceeds will go mainly towards debt refinancing and general corporate purposes, including the development of AI products and services. Tencent has $3.5 billion in debt maturing this year and has pledged to at least double its AI investments in 2026. A filing with the Shanghai Stock Exchange shows Wuxi AppTec plans to buy back around $148 million worth of A shares. That comes after the Pentagon named the drug maker on a list of firms associated with the Chinese military, a threat to its U.S. business, which accounts for roughly 3/4 of sales. The company denies any military affiliation. And shares of US-based AI server maker Supermicro fell in extended trading after it announced plans to raise $7 billion through a package of equity offerings. The proceeds will be used to purchase components needed to fulfill customer orders for its AI servers. Supermicro says it currently has around $39 billion in outstanding orders. Anthropic is leasing powerful computer chips at 5 data centers with help from Google, one of its earliest investors. The deal, amounting to a $35 billion loan, allows the AI startup to lease the chips at the data centers, with chip designer Broadcom also involved in the financing. The circular relationship underscores the complex ties among tech firms racing to pour money into AI. And before we go, here's a look at tomorrow's show. We'll be poring over the final terms of SpaceX's much anticipated stock market liftoff with experts on corporate governance as well as global markets. And that is it for Insight. Horizons Middle East and Africa is up next. Keep it here with us. This is Bloomberg.
The best companies in China build global business from day one. They manufacture in Europe, they invest in Southeast Asia, they hire local talent in Latin America. Chinese companies like online platforms, social media, gaming companies, e-commerce are gaining significant tractions outside of China. We're also seeing Chinese consumer brands are building fan base all over the world. Now, if you look closely, the drive for globalization is really everywhere across all industries.